Hello, everyone. Thank you for joining us today. I'm excited to be with you for the live broadcast of Capgemini's 2021 World Wealth Report launch. This year, particularly special for us because it is our 25th anniversary of launching the World Wealth Report, which is the only report in the market that has been tracking the wealth evolution since 1996. Now, we recap a quarter century of rich insights, examining the wealth sector influencers, macro environmental changes, ecosystem expansion, shifting client profiles and expectations, evolving business and operating models, and increasing role of technology and data. To create this year's report, we surveyed more than 2,900 high net worth individuals across 26 markets in North America, LATAM, Europe, and APAC regions. In addition, to capture the voice of the wealth management industry, we surveyed more than 350 wealth managers and conducted interviews with more than 100 executives across 17 markets. To discuss the changes that the wealth management industry has seen and undergone over the past 25 years, including particularly eventful 2020, I would like to welcome April Rudin, CEO and founder of the Rudin Group, and Elias Ganham, Global Head of Market Intelligence of Financial Services at Capgemini. Thank you.
Thank you, Ayman, for that wonderful introduction, and welcome everyone. I'm here in New York City greeting all of you, and Elias is here in Paris today. I want to begin by thanking all of the participants, attendees, and organizations that helped bring this exciting event to you today, including Standard Chartered, Citi Private Bank, the Edmodo Rocheld Group, InvestCloud, Morgan Stanley, and more. We are coming to you today on LinkedIn Live. We would love it if you would like or love this broadcast on LinkedIn and let us know where you're joining us from. We have a global audience gathered today to talk about wealth management and the wealth tech ecosystem, and we would love to know exactly where you're joining us from. For the next hour, we have put together a global cohort of A-listers who representing the best and the brightest in wealth management, all joining together to commemorate the 25th anniversary of Capgemini's first ever launch of the World Wealth Report, and to speak on the insightful data gathered for this year's publication. Speaking of first launches, we have some congratulatory comments from Mark Fell, Head of Family Office for RBC. He was one of the report's original supporters. Mark?
On behalf of RBC, Royal Bank of Canada, congratulations to Capgemini on delivering the wealth management industry's leading benchmark report for 25 years.
Thanks, Mark. And moving on, let's review some of the trends that the World Wealth Report has gathered over the past quarter century. Elias, how has global high net worth evolved over the past 25 years?
Thank you for the warm welcomes, Ayman and April. Over the past 25 years, both the number of the high net worth individuals and where those individuals are based have changed. Most noticeably, the rise of Asia in terms of wealth, as well as younger high net worth population. Since 1997, the world high net worth individual population grew from 5.2 to more than 20.8 million, as their combined wealth increased from $19.1 to $79.6 trillion. Furthermore, the Asia-Pacific region has progressively raced past Europe and North America to become a significant driver of high net worth wealth growth. As you could see on the chart showing the evolution of the global high net worth individuals' wealth by region, it has been a neck and neck race between some regions, with different leaders of the pack emerging at different times. For example, in 2004, North America surpassed Europe in total high net worth individuals population and wealth, as Germany, France, and Italy were struggling with high unemployment rates. Then, in 2009, while Europe was struggling with the Eurozone debt crisis, APAC overtook Europe. In total, high net worth individuals' wealth as well as population. APAC then surpassed North America in 2015 as the continent struggled with faltering growth during the mid-2010s. Yet, last year, despite APAC's structural advantage, North America surpassed APAC in wealth volume due to the favorable performance of the tech stocks.
It's so interesting to see how the crisis years, such as 2001 to 2002, 2007 to 2008, and of course, most recently, the duration of the COVID-19 pandemic, have impacted global high net worth growth. The world has changed significantly since the pandemic started, and it saddens me to think of the number of losses that people have experienced. The loss of loved ones due to COVID-19 has impacted all of us. And of course, job cuts, reduction in hours, and lack of access to quality medical care have disproportionately affected lower income individuals. The world truly needs time to heal. Now, as we look back on the past 25 years of data that the World Wealth Report has collected over the years, we have high net worth individuals' expectations of what their wealth managers have also changed over this time, Elias?
Oh, yes, they certainly have. Over the years, high net worth individual behavior has shifted completely from a hands-off approach to a much more increasingly asking more from their wealth managers. On the slide, we can see the timeline of these behavioral changes, which you can read about in greater details in our 2021 World Wealth Report, available online on worldwealthreport.com. Looking at recent years, there was a rising ask for digital interaction and real-time reporting. Between 2010 and 2015, we have seen this real-time reporting. However, at the same time, direct interaction became even more important, with high net worth individuals requesting for personalized advice, for customized services, for goal-based financial planning, and finally, for pay-for-performance fee structures. Then, between 2015 and 2020, high net worth individuals embraced the hybrid advice models and modular financial planning services. They sought hyper-personalized services and omni-channel connections with their wealth managers. Additionally, they began allocating significant portion of their portfolio to ESG investment, which is great, and we love that. As we look forward, data, behavioral finance, sustainable investing, and hyper-personalized engagement through a very omni-channel experience will be essential.
Thank you, Elias, for that overview. Over the next 50 minutes, we'll have experts from all over the world to discuss the findings of Capgemini World Wealth Report 2021, including key takeaways like the need to hyper-personalize the client experience, how to add value through product innovation and technology, and much, much more. If you can't join us for the entire broadcast or you miss anything, know that all these sessions are going to be available for playback on the Capgemini World Wealth Report website, which Elias mentioned a few moments ago. And feel free to share all of this information in your networks and with all of your colleagues. So let's jump right in, Elias. Let's begin with our favorite topic, hyper-personalization.
Yes, since 2018, we've really seen high net worth individual demand for hyper-personalization grow. Fortunately, at the same time, technology has also made it possible for wealth managers to hyper-personalize at scale and to profitably engage not just the wealthiest investors, but also the mass affluent segment as well. Yet, this hyper-personalization should not be done blindly. Rather, a thorough understanding of behavioral finance is necessary to truly understand the customers and hyper-personalize their experience. This understanding, in turn, will yield deeper client insights and much more targeted responses, as well as personalized investment proposition, and even enhance advisors' profitability. We can see some of the wealth management industry utilizing behavioral finance effectively already. Let's take some examples. Goldman Sachs FinLife platform uses behavioral finance tools to give advisors a deep understanding of individual clients' needs, which helps build a foundation for financial planning and individualized investment strategy to truly meet clients' personal goal. To discuss this topic in greater detail, I'd like to introduce Dr. Ashley Williams, Assistant Professor of Business Administration at Harvard Business School, who will be interviewed by Lauren Young, editor of Reuters Wealth.
Thank you for joining us, Dr. Willens. What do you think are the key lessons from the pandemic for wealth management firms?
So wealth management firms, like so many industries, rely on relationships between people and mitigating risk. So I think the key insight from the COVID-19 pandemic is that we need to manage uncertainty and form and establish and maintain social relationships, regardless of what's going on in the social environment.
And the Capgemini World Wealth Report describes behavioral finance as a tool that can help firms study the impact of emotion on their clients' investment behavior. Can you give us an example of how that works?
Yeah, so behavioral economics has a lot to say about how people think about making decisions about important resources like time and money. And so as we're thinking about using behavioral insights, we want to be thinking about the fact that people don't always make rational decisions. Despite how much money people have in the bank, they might be thinking, especially during a period of uncertainty, about how to maximize short-term gains, as opposed to long-term benefits. So we really want to be helping people feel a sense of psychological safety and trust so that they can make the best decision for themselves, not just in the short run, but also in the long run.
Wealth management firms are looking for ways to get closer to their clients. How can behavioral economics help with that?
Behavioral economics suggests that, once again, we often underestimate the power of small social interactions. We don't always know what's good for us, if you will. So one thing that we've observed during the COVID-19 pandemic in these remote environment that we've been working in is that small social interactions often go missing. These can be the source of so much important connection and trust building time, but also a source of innovation. So as we move out of the pandemic and into our new normal, we need to keep small social interactions in mind, not necessarily 3-hour Zoom meetings, but rather those short check-ins that often go missing in a virtual environment.
Do you think wealth management clients should be concerned about privacy given everything that's going on with technology in the world right now?
This is a really interesting question. So you might wonder, should we be transparent about the extent to which we're using information from clients to help optimize their experience? Research from behavioral economics and behavioral science suggests, yes, we should actually be transparent about how we're using people's data, so long as it's improving the user experience. When we're transparent, we explain and communicate the why behind our decisions, this can actually facilitate consumer trust, not undermine it.
And looking around the globe, which geography would you say is more advanced in terms of using behavioral finance and behavioral economics?
There's no question that the United States is a front runner in this area. There are more economists in top finance and firms and in top technology companies than in the top universities in the United States. So there's definitely proliferation of economics and behavioral science in the United States. But there's also been a trend in emerging markets. We see that emerging markets, there's the potential for increased scale and decreased bureaucracy. So I do think that countries like the United States and North American markets have a lot to learn from innovation that's happening elsewhere in the world.
Dr. Willens, thank you so much for joining us.
Thanks for having me.
What a great segment. And thank you, Dr. Willens and Lauren, for guiding us through what wealth management industry can learn from behavioral economics and the COVID-19 pandemic. I know that I learned so much from Dr. Willens about the knowledge of behavioral economics and how it can help wealth management firms with their own client relationships. Wealth management firms, of course, rely on relationships between people and mitigating risk, as she stated so well. And we need to manage uncertainty while forming, establishing, and maintaining relationships regardless of what's going on in our social environment, like the pandemic. And all of this has been brought into sharp relief, whether we liked it or not. Small social interactions, as she said, can sometimes go missing during times like these. So remember to keep small social interactions and important connections between people within your organization, whether it's colleagues or clients, and they all become important for establishing and keeping connections, trust building, and even innovation. Relationships, as we know, are really everything, and that you can directly foster innovation by maintaining small interactions is just one great key takeaway from this session. In the 13 years since I founded the Rudin Group, the amount of relationship building and innovation in the wealth management industry continues to astound me. And this has been a true silver lining during the pandemic. This brings us to our next topic, which is product innovation and fee models.
Yes, April, providing innovative products and fee models that are very closely aligned with high net worth individuals' preferences and value are becoming key differentiators in the wealth management industry. For example, in 2020, 32% of the global high net worth individuals expressed discomfort with the fees they paid, which is a continuation of a trend that we also saw in 2019. There are really two takeaways from high net worth individuals' continued dissatisfaction with fees. First, fee models need to evolve. There is a disconnect between the way firms usually assess fees and the fee model that clients want. High net worth individuals want to move away from asset under management-based fees and shift to a performance-based fee structure. Moreover, high net worth individuals want to explore new fee structures, either through traditional firms or even through wealth techs. Second, wealth managers will need to look beyond traditional products and instead offer a wider array of investment vehicles. This includes cash management solutions to maximize return from savings, new offerings such as cryptocurrency or even carbon currency, and new investment avenues adapted to the tech industry, such as the famous SPACs that we're a lot hearing about it lately. As a model, they may wish to look to wealth tech. To speak more on this topic, I'd like to introduce Christine Siriani, CEO of Private Banking and Wealth at InvestCloud, who will be interviewed by Stephen Waxtill, Money and Wealth Editor at Financial Times.
Welcome, Christine. The studies show that there's a great gap between the satisfaction that wealth managers want to achieve when they're serving their clients and the sentiments that the clients actually express, particularly when it comes to fees. What do you think is going on here?
Stefan, absolutely. I think in the last year, we've had a couple of different market effects. We have intergenerational wealth transfer, which means a lot of the wealth is moving to younger hands, and also an enormous amount of market volatility, right? Almost 40% drop if you look at the month of March last year. So that's causing a lot of clients to look at the private banks and want to really demand transparency and the value they get for that transparency and the value they get for their services. What is also interesting is that studies have shown that actually clients are ready to pay fees. It's not that they don't want to pay fees. They're not looking for a zero fee model, but what they value has also shifted. And therefore moving to having an advisor not only explain the value of the advice that they give, but educate their client as well, and maybe extend their services to not just investment products, but non-investment products as well, which they value more as a holistic service, is gaining traction, particularly among that next generation as well. And as studies have shown that a third of clients may and will look to potentially move their assets to banks that match what they're looking for over the next few years, that focus of attention has really heightened in terms of need as well for the banks to listen to.
Do you think that the pandemic and the changes and shifts that it highlights creates an opportunity for private banks to reconnect with clients? And if so, what do you think they should do?
So what's interesting is we hear even more. I mean, the topic of hybrid advice has already been in the market for some time, but even more, the accompanied advice has become even more valuable. Again, a negative interest rate environment, big shocks in the market. And usually when markets go through these kind of shifts, clients actually move out of equities instead of moving into equities. And yet those who've been able to move in equities at the right time and take advantage of restructuring credit with low interest rates, they've been able to benefit as well. And again, from a macro perspective, we do see wealth growing over the last years, and the wealthier population who have been able to invest their assets benefiting from that even more. So the ability to actually accompany a client remotely, provide that education, and to provide that explanation of what a client should do more holistically during the last 12 months has increased as well.
There's a specific point that clients raise to do with wanting to pay fees for specific services rather than a percentage of assets under management. How do you think that private banks should handle those clients? What is it they should offer and what is it that they shouldn't do?
Yeah, it's very interesting. Obviously, the banks will want to have a flat fee approach and even an approach that's probably a bit more linear but consolidated in terms of fees. What clients are looking for is predictability, which allows them also to use an open wealth environment and go to different players for different services. So potentially online players for the trading, potentially more family office for more wealth planning, potentially the private bank, again, to access investments they couldn't access otherwise. So I think what we are seeing is banks not only looking to actually unbundle services, but to look at where they gain their value across relationship. Again, Goldman Sachs recently, for example, they decided to reduce their minimum fees, but they realized that they actually gained from credit, offering higher margin products, like structured products to the same client base, and therefore where they gain their fees from. I think from what we're seeing also is banks respond to this desire of clients wanting to unbundle some of that fee and being able to really identify what is this wealth manager particularly good at, because they're going to be multi-banked, and to make sure that they're charging fees and getting the value from that particular service.
And just finally, you mentioned the intergenerational wealth transfer. What is it that appeals to young people in terms of fees and services, and what doesn't?
So it's interesting. We're seeing a greater demand for transparency, but to understand also where the investments are being invested, what's the impact their investments have, and an ability to shift their preferences, particularly as they see their, not just the performance of their investments, but the impact of their performance as well. In terms of fees, I think that it's the next generation are not looking necessarily, again, for fees to go down. They're really looking to match what they value and to pay for that valued service, which becomes actually more around the servicing. And in some ways, when you look at it, private banks have always been known for high touch servicing, and their servicing needs are slightly different. So their servicing needs are not just that a banker can actually authenticate them on the fly and give them advice on the fly. They also want to be able to access information remotely. They want to exchange information remotely. They want to be able to educate themselves, whether it be through podcasts, webinars, community events as well, to make sure the investments are being put into use in areas that match their preferences, whether it be ESG or sustainability or impact investing, so that their investments make a difference as well as actually have high performance as well, and the ability to collaborate and exchange ideas with the relationship manager as well. So again, shifting that holistic advice and shifting that relationship to be much more collaborative, much more point, and therefore paying for that value, which is more punctual servicing.
Right. So there's plenty to do and plenty of opportunities. Thanks very much, Christine.
Thank you very much.
Wow. Thank you, Christine and Stefan, for that insightful session. There's so much to unpack, and obviously fees and revenue changing is a really important topic for wealth management firms, family offices, private banking. So remember that you can find out more information if you download this year's 25th anniversary Capgemini World Wealth Report. I've often said that the one-size-fits-all approach doesn't really work, and it's interesting to know how it's really impacted younger investors and how they feel about fees. And also just interesting to think about how the one-size-fits-all and hyper-personalization doesn't apply to fees, or does apply to fees also. So I can see wealth management firms, private banks, and the like also offering different fee structures to appeal to different clients based on what their individual preferences are. On another topic here, I just want to take a moment to acknowledge what a pleasure it is to see so many women like Christine and Carla Harris in senior roles in the wealth management industry. I'm also pleased by how many women we have involved in today's event. While we can certainly do better, it's no longer an old boys club in wealth management. This event itself and the rise of female investors is a testament to how much the wealth management industry has evolved since the publication of the first World Wealth Report 25 years ago. Elias?
And just as the industry has evolved, so have its high net worth clients as well. This brings us to our next topic, which is about emerging client segments. 25 years ago, the typical high net worth investor was an older white man. That is no longer the case. In fact, one finding of the 2021 World Wealth Report is that women, younger high net worth individuals, and LGBTQ+ clients are becoming increasingly prominent. One reason for this is the growth of women entrepreneurs, which increased by 114% in the last 20 years. And today, 40% of US business owners are women. Wealth managers have to be able to communicate that they are aware of female high net worth clients' unique needs and concerns, and be ready to fulfill those specific needs. One of the firms doing this already is Elavest. Its digital investment platform addressed a market gap and is designed to meet women's needs, including investing algorithms that consider women's unique financial journey. Meanwhile, wealth managers truly need to embrace more digital technology to better appeal to younger high net worth individuals under the age of 40. By the way, nearly half of which are not satisfied with their firm's digital maturity. The famous great wealth transfer to millennials that has been discussed for quite some time is truly happening now. To discuss this topic in much greater details, I'd like to introduce Carla Harris, Vis-Chairman of Wealth Management at Morgan Stanley, who will be interviewed by April.
Carla Harris, thank you so much for joining us today.
Well, thank you for having me.
I'm just going to dive right into the questions. So one of the evolving wealth management client trends that the 2021 World Wealth Report documents is the rise of female entrepreneurs in the U.S. Female entrepreneurs increased by 114% in the last 20 years in the United States, with 40% of U.S. businesses now being women-owned. What are some of the unique financial needs that female entrepreneurs have, and what can wealth managers do to appeal to this segment?
Yes, thanks so much for this question. The first big issue is that, as you know, there's an inequity in the distribution of capital to women and entrepreneurs of color. And oh, by the way, April, you know that small businesses are the biggest contributor to job growth in the country. And women, as you said, are the fastest growing segment, and women of color, frankly, are even faster within that segment. So the big deal is around the access to capital. So what wealth managers and investors can do is to look at some of these early stage companies that have a great growth trajectory, especially those that are tech enabled and that are run by women, and look to invest in some of those companies. These are going to be the unicorns and the moonshots 2 years from now, 5 years from now. So now's the time to play.
Yeah, that's certainly an exciting time. Picking up on what you said about technology, another trend in the report notes that younger high net worth individuals have a increasingly demand for digital. As the report shows, 47% of high net worth individuals under 40, though, are not satisfied with their firm's digital maturity. So many wealth managers have been trying to increase their digital capabilities over the past few years. So given that nearly half of ultra high net worth younger individuals are still not satisfied, what types of digital capabilities should firms be prioritizing?
Yes, there's no question. And these guys are digital natives, as you know, millennials and Zers. So it would behoove almost every financial institution to double down and actually increase the acceleration around investing in technology, because this is how they connect. This is how they consume information. And I would also say that firms should invest in making sure that their advisors are brought up to speed. Because as you know, this is a business, April, that you can stay in until you're 70, 80 years old. And interestingly enough, there's going to be a huge wealth transfer to millennials and Zers over the next 5 years, let alone 10. So in order to continue to serve these customers and these emerging customers, especially if you are 40, 50, early 60-year-old advisor, you need to catch up now. And if you're a 70 or 80-year-old advisor, then I would still say you need to spend a significant amount of your week investing in new technology and understanding how to use it, because that's how they're going to engage. And they are inheriting trillions.
100%. I mean, I love the way you brought up the average age of the financial advisor now is age 60. So in terms of digital, they really need to up their game in order to still be playing.
Mm-hmm.
So moving on, recently there's been a lot of popular discussion about the division between what's been called so-called geriatric millennials, those born between 1980 and 1985, and younger millennials. What are some of the differences that we might find between older and younger millennials in terms of what they're looking for from wealth managers? And how can firms appeal to both segments of millennials?
Well, I have to tell you that I spent a lot of time with millennials, those that are born in 80 to 85. I refuse to call them geriatric. And, you know, in my opinion, April, they all are sort of looking for the same thing. They want connectivity. They want someone who can have the patience to teach them, because they do want to learn, interestingly enough. But I will say one distinction is those that are born between 1980 and 1985, these folks are now 40 and 41 years old. And you know as well as I do, as you get more seasoned, not old, you tend to acquire more wealth. And as you acquire more wealth, there are more sophisticated and complex needs. So I think that as people think about serving the millennial population, you should certainly think about the base between all of them in their digital. They want information. They want it yesterday, because they're used to that immediate connectivity. But I'd say that the things that you talk to your more seasoned clients about, your wealthier clients about, those are the topics you want to introduce to those that are born between 1980 and 85. Those who are, in the 90s and they are millennials, those are the ones that I think you want to talk about overall wealth building, but you also want to think about experiences, because all the studies have shown that they value experiences. So when you're helping them think through how they want to deploy their capital and their assets, or what you can do to be of value to them in a relationship, think about experiences.
That's great. Thank you so much for joining us today, Carla. It's a pleasure speaking with you.
Thank you for having me, April.
The great wealth transfer in action. Thank you so much, Carla and April. As new client segments are growing in prominence, the asset class landscape also is evolving. In fact, this is the topic of our next segment. As we saw during the 2002 tech bubble collapse and the 2008 financial crisis, high net worth individuals tend to flock to safer asset classes like fixed income and cash equivalent when financial markets turn volatile. Even those who choose to invest in equity tend to switch from growth to value stocks during volatile times. However, That was not the case during the recent COVID crisis. After an initial decline, equity market quickly picked up again, and high net worth individuals have earmarked nearly a third of their portfolio to equities.
That's so interesting. As we get ready to talk about alternative investments in our next segment, even the definition and the offering of alternative investments has been evolving very quickly, especially among younger, ultra high net worth investors, and combine that with the proliferation of digital. The digital era has certainly been a catalyst for new asset classes such as cryptocurrency, NFTs, even digital tokens of traditional assets. But that's not all. It's possible that someday soon that what we now call alternative assets may now overtake what is so-called traditional assets. I'm looking forward to hearing more about the evolution of alternative assets. Elias?
Oh, that's certainly correct. To speak on this changing landscape, including alternative investments, I'd like to introduce David Balin, Chief Investment Officer for Citi Private Bank, who will be interviewed by Suzanne Woolley, wealth reporter for Bloomberg.
One of the findings of the 2021 World Wealth Report is that alternative investments tend to be the most popular with ultra wealthy individuals, those with investable assets of, say, 30 million or more, compared to the less affluent but still wealthy millionaires next door. What are some reasons why alts tend to resonate with the wealthiest individuals?
Well, the structural reason has to do with the need to qualify, right? To either be an accredited investor or qualified investor to even begin to get exposure to those areas of investment. But really, it has to do with diversification. The idea that, the more wealthy you are, the more asset classes you want to get exposed to and the more diversified your portfolio wants to be. So I think that that's really the interest of the ultra high net worth clients. And then most recently, we've seen a whole lot take place in direct private investing, where ultra high net worth clients want to actually get exposure to individual companies or individual opportunities and build those into their portfolios just simply because they're of great interest to them personally.
Cryptocurrencies have been hailed as the new alt. Are cryptocurrencies popular among ultra high net worth and high net worth individuals? And if not, what type of alts tend to be more popular?
Well, cryptocurrencies have become captivating. Right now, if you think about gold as an asset class, there's about $5.5 trillion worth of gold and about $1 trillion worth of cryptocurrencies out there. So it has become a big deal, and it is popular among a handful of investors. But we don't consider it an alternative asset class, rather actually a speculative or opportunistic investment that some people want to hold. And the reason is because we see alternatives as actually providing exposure to an industry, to a group of companies, to a specific asset class like real estate. And those are, I think, much more diversifying than an exposure to cryptocurrency would necessarily be in a portfolio. But there's no question that they are very popular and that they actually represent a window in the future about the digitization of everything.
Jumping off of that, what alternative asset classes are most interesting to younger ultra high net worth and high net worth clients versus what their parents or grandparents might have been most interested in?
Well, I mean, it's a great question because I think there's a lot of substitution that's going on now. And a great example of that has to do with all things ESG, environmental, social, and governance. A younger investor, wealthy or not, is going to be very interested in the social impact that their investment has. They want to see an outcome, not only an investment outcome, but an actual impact outcome. And so an example of that would be, instead of buying a conventional bond that a company may issue, they may be interested in buying a bond that's issued by a not-for-profit, for example, for UNICEF. So we saw a bond actually issued this past year, guaranteed by the World Bank, but of course where the monies would actually go to the benefit of this organization. And there was extraordinary interest in that, right, because of the social impact nature of it. So there's the substitution impact. There's also investments in areas that I think could have great social impact in a literal sense. So for example, if you're going to build an energy delivery mechanism or a telephone delivery mechanism, cell phone delivery mechanism, the technology to do that in an impoverished area is getting cheaper and cheaper. And so you can actually imagine a series of investments where you create a change of quality in life and a return on investment for an individual investor who's younger. And so all of these trends are underway. They're well established, and we're seeing more and more businesses provide opportunities for younger investors to do those things.
Is there a trade-off in terms of return?
Well, there is a trade-off in terms of return, and there really are two different groups, right? There are those who are willing to give up either the return on investment or the return of their investment to make social change happen. But what we see now is that with the reduction in the cost of technology, the possibility of making a good return and of actually doing good is really readily available. And we're seeing both of those things take place right now in portfolios.
Great. Briefly, any predictions on the future of alternative asset classes? Are NFTs here to stay?
They absolutely are. I mean, the digitization of everything is underway. The way we own alternative investments will ultimately be through blockchain. We'll have, instead of a security, we'll actually have a digital form of that. We're going to see, I think, massive change in the ownership of assets. We've heard about NFTs, but just imagine if we took a Picasso or some other piece of art and literally divided it into 100 units that were tradable. That will actually, I think, take place in our lifetime. And then there are going to be, the fact that everything will become an alternative investment. Most recently, we've seen younger investors get very involved in the ownership of sports teams. There have been funds put together, literally, that can let you own a share of a Major League Baseball or Major League Soccer team. So all of that, portends, I think, a very bright future for alternative investments, not only as an opportunity to diversify portfolios and make returns, but also to actually have a good time, in the enjoyment of assets in a way that we haven't thought about before.
Great. Thank you.
Thank you, David and Suzanne. So much to unpack there. I mean, imagine enjoying some of your alternative investments. I love this segment and a lot to unpack. Here's just a few points that stuck out to me. The distinction between true alternative assets and speculative or opportunistic asset classes is really helpful to understand the place and opportunity for cryptocurrency and portfolios. Another interesting trend that was discussed is the desire by ultra high net worth to directly invest in individual companies instead of just asset classes, especially as they follow their passions. And of course, ESG has become a rallying cry among younger investors, and the substitution of more traditional alternative investments like real estate. This will obviously be a growing need that all wealth management firms must address for all of their investors, not just their younger investors. I just want to take a housekeeping moment here. So for all of our listeners, if you've just joined us, make sure that you take time to let us know where you're joining from, like and love this broadcast, and make sure that you share this with all of your colleagues. It's truly remarkable to see how the wealth management landscape is changing. Firms are facing a dynamic macroeconomic environment that includes rising costs, revenue pressures, and evolving customer expectations. Meanwhile, they're suffering from the digital gap due to historic limited investment in technology. In this environment, they may wonder how they can deliver on customer expectations while ensuring profitability. Elias?
Oh, yes. Sustainable investment before that. We'll come back to it a lot just after. But now let's talk about truly, we believe that firms need to collaborate effectively and at scale with the open ecosystem, including WealthTech, to truly accomplish those aims. We are seeing some of that engagement already happening. For example, nearly 1/3 of wealth management firms are already partnering with WealthTech to either gain access to new client segments or providing new and unique offering to existing clients. Although both wealth management firms and WealthTech believe that collaboration is essential, partnership at scale is not always easy. That's why we have created the Capgemini Openx Readiness Index, which benchmarks a firm's readiness to work with an open ecosystem to offer the right experience, thus Openx, with the X standing for experience. You can read about the index in greater detail in our 2021 World Wealth Report, available online at worldwealthreport.com. And to speak more on this topic, I'd like to introduce Pierre-Olivier Bouet, EVP and Global Sales Officers of Financial Services at Capgemini, and Mark van de Vel, Global Head of Wealth Management and at Standard Chartered.
Hello, Mark, and thank you so much for joining us today. It's a privilege to be with you for a session that will be all about innovation and collaboration between wealth management firms and fintech. So let me start with the first question. Capgemini World Wealth Report 2021 talks about the Openx Readiness Index. This is a structured methodology we have developed to evaluate the readiness of wealth management firms to collaborate at scale with startups. And we are very lucky to have Standard Chartered Bank as part of this program. So let me ask you, from your perspective, what are the drivers for Standard Chartered Bank Wealth Management to collaborate with startups?
Yeah, well, first of all, Pierre-Olivier, let me thank Capgemini for having me today. It's really great to be here. To your question, partnership and collaboration with startups has become critical in many ways for large banks like Standard Chartered. And I see three main drivers for us. The first one is innovation. Startups operate at the frontier edge of technology, and they provide us with access to very specific services that may otherwise take much longer to develop in-house. And we've set up a dedicated mechanism through SC Ventures to evaluate such ideas, not just for wealth management, by the way, but broadly for the whole bank, so that we can bring in some scale to our aspirations on innovation. And an example of a startup collaboration in wealth management is that we recently launched SC Gold Planner, a financial planner tool, in Singapore in collaboration with BTO. A second driver is the speed of response. The last 18 months have clearly demonstrated that we need to be fast and agile to respond to unprecedented circumstances, but also to changing client needs. So working with startups allows us to sometimes respond with more speed and efficiency. For instance, we launched a service called MyRM in collaboration with Moxtra, which allows our clients to interact seamlessly and securely with their relationship managers. And that was very handy when face-to-face interactions were made unfeasible during the pandemic. And the last driver is scale. Going forward, I believe that wealth management will become more and more democratized and start reaching the masses. We're working on solutions where partnerships will play a major role in taking wealth to the masses. And for instance, we're looking at extending discretionary portfolio management solutions to the mass segment. And for this, partnerships with startups and fintechs will be key.
Thanks for sharing all these drivers, Mark. Let me now turn, if you agree, to the challenges. And can I ask you to share with us some of the challenges that an organization like yours may be facing when trying to collaborate, again, at scale with startups?
Yeah, startups are definitely not a silver bullet. So I can see three challenges, or challenges in three categories. The first one I would say is enterprise-grade security and the readiness of the startup. Big banks like Standard Chartered operate in a heavy regulatory framework, and so we have strict information security, cybersecurity, and compliance regimes. And so one of the key risks that we need to manage working with startups is the compatibility of their technology with these requirements. And beyond the technology itself, it's also the readiness of the management and the mindset of the management of the startup. The second challenge is sustainability. We need to factor in the financial strength of the startup and their ability to navigate uncertain times and economic downturns. We want to partner for the long run, and therefore it's important that our startup partners have a sound financial standing. And the third challenge that I see is a sort of a reverse challenge. It's a challenge that we pose to startups. We have big financial institutions, have different timelines, and they operate at a different pace compared to startups. And for startups, that can be challenging because for them, it's sometimes a question of survival. They need to see the cash flow. But we have heavy internal requirements. We're sometimes complex and have heavy processes that can be overwhelming for startups. Now, these things we are trying to simplify, and we're working hard to simplifying those within Standard Chartered.
Absolutely, this is great. Thank. And you mentioned readiness, so maybe I should have my last question about the Capgemini Openx Readiness Index, given that, as mentioned, Standard Chartered is part of this program. Can I ask you, how useful is this global benchmark to compare the maturity of your organization to other players?
Well, I think it's a great initiative. We went through it, and it got us thinking more structurally about a framework to collaborate more and more with startups. And it was also very useful to get a sense of where the market is and how we compare with that. And we were pleased to see that we were not one of the laggards. So that was nice to see.
Yes. Mark, thank you so much for joining us today and sharing your thoughts. It's been a true pleasure to be with you today, and I really look forward to seeing you soon.
Pleasure was mine. Thank you for having me.
Well, thank you, Pierre, Olivier, and Mark. It's been a really seismic shift away from we must build it here and a move more toward partnerships. And that's been a really important takeaway. And it's fascinating to hear exactly how Standard Chartered is collaborating and partnering with startups and how that collaboration is really fostering innovation and agility. And of course, it's a Capgemini Open Index program that's facilitating these relationships. And not only the winners are, of course, the banks, the private banks, wealth management firms, but ultimately the winners are all of the customers and clients of these firms as well. My takeaway from this session includes the 3 drivers for mutually beneficial partnerships, as Mark was saying. So number 1, innovation outside of the bank, at the frontier, as he says. Speed of response to changing client needs, particularly in situations that are black swan, like the pandemic. And then scale, how to take wealth management to the masses. So I think these are the 3 trends that we should pay attention to. And the discussion of wealth management ecosystems during this segment flows quite naturally to the final topic of this event, which is sustainable investing. In recent years, high net worth individuals' interest in sustainable investing has taken and gained so much traction, and it feels like it's maturing today. Sustainability has been a top priority for both high net worth individuals and wealth management firms, and it's taken on even more significance since the COVID-19 crisis. Can you tell us a little bit more about that, Elias?
Certainly, April. Now, in fact, what you are noticing is the conversation is moving from the importance of sustainable investing, which is already on everybody's mind, to the effectiveness of sustainable investment products. And high net worth individuals want more sustainable investing information. In fact, the 2021 World Wealth Report found that 43% of the ultra high net worth individuals and 39 of the high net worth individuals under the age of 40 are likely to request an ESG score for financial products offered by their firm. High net worth individuals also seek customized solutions, such as embedding ESG scores into their existing portfolio. Yet, at the same time, wealth management firms are facing challenges, such as difficulty obtaining accurate data on various company ESG impact and lack of clarity regarding sustainable investment returns. It is for these reasons that we believe that addressing challenges around scoring, advising, tracking, and performance is the next frontier for sustainable investing. In sum, wealth management firms must push the frontiers and evolve from blend sustainable investing products to embedded ESG scores in everywhere in the high net worth individual portfolio. To discuss these new frontiers in greater detail, I'd like to introduce our final guests, Ayman Izzat, CEO of Capgemini Group, and Ariandel Rocheld, President of the Edmodo Rocheld Group.
Hello, Ariane. Nice to see you again, and thank you for spending some time with us.
Yes, thank you very much.
So I know that you and the Edmodo Rocheld Foundation play a pivotal role in encouraging social empowerment. And I would like to have your views on the topic of inclusion and social empowerment and how you think the firms across the industry are addressing it.
Yes, thank you very much. Yes, actually, over the past 15 years, our foundations have been very active on these issues, mainly in Europe, in Africa, and Israel, through a wide range of programs that go from education, social entrepreneurship, or tailor-made programs for leadership. I would say social inclusion and empowerment are really key to a resilient and sustainable society and economy. We did a research in-house over the last 3 years, which highlights how vital human capital is for long-term growth for countries on one side and companies. Long-term growth and value creation not only depend on technological progress, but also on the accumulation of human capital. Therefore, education and training increase productivity, improve the capacity to innovate and to spread new technologies. So if you take investments in intangible assets, such as R&D or softwares, they will increase your average productivity, but they are insufficient to guarantee a long-term performance if they're not supported by significant investments in human capital. I think this pandemic will transform deeply and accelerate companies' internal and external policies towards social responsibilities.
I mean, this is great. So now if you shift a bit the topic and we talk about sustainable investing, as there is an increased traction on that front from investors, what do you see as some of the trends you're observing today in the industry? And how is Edmodo Rocheld supporting their clients and asks in that area?
So I think it's a really interesting times. Again, I was talking about this acceleration, and you can really see today a conversion or alignment of interest between politics, economics, and investors' appetite. In the last years, there's been a significant surge in sustainability disclosures, financial, non-financial. And there's a study that shows that companies that fail to meet investor expectations on ESG issues really risk losing their access to capital markets. And I would say since his inauguration, President Biden has taken significant steps to move forward, combating climate change and addressing social inequality. One of his key steps is the nomination of Gary Gensler as to lead the SEC, and I think we can expect that he will push for more transparent and standardized ESG regulation. Also, you can see that the gap for ESG metrics will close at a faster pace than we expect, because we're really moving from principle-based disclosure towards rule-based, i.e. Regulatory compliance. I think it will increase accountability, clean and uniform ESG reporting among all industries, and obviously increase compliance sentiment. At our bank, we are 85% of our assets under management are already ESG. And we are just shifting to, before year-end, will be fully ESG compliant.
So if you think a bit about that acceleration in terms of basically demand around the reporting on ESG, on the other side, what kind of sustainable investment are the wealth management industry rolling out now to be able to address some of this demand in the market?
So I think you're seeing an acceleration in the range of products from liquid to illiquid. So equity on one side, which is really leading the development of new products, of new funds. Credit, that really represents 20% of new ESG funds. Credit products will be accelerated by the green and social sustainability bonds, especially also carried forward by companies, central banks, and development projects coming out of the pandemic. I think you also have ETF, a fantastic growth in ESG ETF assets that are really of late growing at a very fast pace.
Okay, so now we expect trillions to be invested, but how do you expect this to evolve over time, and how can wealth management firms cater to this shift?
So I think I'm expecting several shifts. I would say the first is moving towards a greater attention to compliance, to good governance. We've all been focusing a lot on the environment, now the social aspect of ESG, but we are personally giving a lot of attention to governance. The second is a shift towards impact investing and really going beyond ESG. The third, I would expect a development in thematic funds. Why? Because you are going back to impact and being much more focused on where you are investing. The fourth trend, I would say, probably in some areas is I would particularly private equity. Some of the fees will be structured differently, with part of the fees correlated to impact measures. And I would say the fifth trend is really focusing on value chains, so investors integrate the full vertical value of ESG.
Well, thank you very much, Ariane. Great to see you again.
Thank you very much.
Thank you so much, Ayman and Ariane. What an optimistic and a positive session. We can all feel good about that. And I think if there's one positive or one bright side to the negative, of course, of the COVID-19 pandemic, it's been its role in accelerating the transformation of companies' policies on social responsibility. The rise of inclusion, social empowerment, and sustainability makes me hopeful for our future, and not just of the wealth management industry, but for the entire world.
Amazing. Thank you so much, Ariane, for the vision that you shared with us. Thank you, April, and thank you all. It has been a marvelous near hour of discussion. And I'd like to end by offering once again a way forward. If there is one underlying takeaway from the Capgemini World Wealth Report 2021, it is that it is time to push the frontiers of wealth management to truly capture customer mindshare. That means that wealth management firms have to embrace new age competencies to capture new opportunities. Times are changing, just as they have changed over the 25 years since we launched the first World Wealth Report. Now, wealth management firms must embrace the hybrid advisory model, embrace it at scale as well, to digitally empower high net worth individuals while capturing opportunity from the mass affluent segment that we've been talking about. Finally, wealth managers must adopt the skills of new age tech firms while maintaining the identity of a traditional wealth management institution, a feat that is only possible through collaboration in the ecosystem.
Wow, so many interesting findings for the Capgemini 25th Anniversary World Wealth Report 21. But we've just really scratched the surface. There's so much that I even want to dig into. Watch these segments again, download the report, and really dig into it, because there's so much valuable information that firms can use for their planning in so many different ways. So I just want to wish, again, a very happy anniversary to Capgemini on these past 25 years for the World Wealth Report. I want to thank all of our viewers who've joined us from all around the world. And thank you to all of our wonderful participants, panelists, who've added so much to this conversation and dialogue among global wealth management and wealth tech professionals. So cheers, Capgemini, here's to you.
Cheers to you.
Finally, we have some congratulatory comments from Craig Young of Merrill Lynch, another early World Wealth Report supporter.
Hey, thank you, April and Elias, and congratulations to Capgemini on 25 years of global industry research. The better we understand our clients, the better we can serve their evolving wealth management needs.
Thanks, Craig. Please remember that you can visit worldwealthreport.com to register and download our 25th anniversary edition, as well as to access the previous 24 editions from our archive. And to celebrate the 25th anniversary of the report, we are making available for free 25 years of market sizing and asset allocation data. Go there and visit it. Please continue the conversation and connect with us on social media through the hashtag WWR21. Have a wonderful day or evening, and thank you for joining us. Cheers to all.